Do you have to understand cash flow to run a business?
I think it really helps, and if you don't understand it, then someone in your business needs to help you to understand it, just so that you can keep an eye on it, because it's one of those things. If you run out of cash because you've gone and paid everything, all your expenses out, but you've not focused on getting your cash in from the people who owe you money from your debtors, then it could mean that you run out of cash.
Okay, well,
and then
let's just take a step back. Explain for the listeners what the term cash flow means and why they need to know about it.
Yeah, cash flow is the flow of money coming into and out of the business. So cash flow, I think, is a very popular term. It's bandied about a lot. And it really is. It's cash flowing in, income coming in, and looking at income going out, income flowing out of the business. And it's all about the timing of those payments. So it's all very well, having £1 million flowing in at the end of the month, but if at the beginning of the month you've got payments to make, then the cash won't be there to meet those obligations. So it's about managing the flows of the money in and out.
Okay, so money comes in from sales usually, and it goes out obviously as expenses.
Right.
I've heard businesses can be making a profit in that way, but still run out of money.
Yes.
How does this happen?
Right. Well, and it depends on the type of business, but let's take a business who is selling their goods or services on credit. So that means that they're sending out, they're performing the work, they're doing the job, they're sending out their invoices to their debtors, to their customers, to their clients, and then they're waiting for that payment. So on paper, on a profit and loss account, it would look like, you've made a lot of sales, that's fantastic, you've made a profit, but if the cash, the money for those sales hasn't been received yet, then cash-wise, they haven't got the cash in their bank account. And so some business owners really aren't even bothered about the sales or anything like that. All they want to know is the bottom line. Is there any cash in the bank account? That's all they're interested in. If there's cash in the account, they're happy. If there's none, then they're not happy. But cash flow is all about keeping an eye on your bank account and your flows of money coming in and going out.
Well, you've got money coming in from sales, and you may find that the cash flow isn't as efficient as it should be, so you might take out a loan to kind of bridge a gap. Are there any other ways that you can fund cash flow?
Well, sometimes, businesses are growing so quickly, they need the cash to buy more stock to sell and so on and so forth, so things can really be taken off. So it all depends on what kind of business it is. So, for example, if it is a type of business where you've got stock that you're selling, it could be a matter of taking credit terms, if possible, from the person who you're buying the stock from, so that you're not immediately having to spend that cash to buy the stock to then have to go and resell it. So it's almost like using your suppliers almost like as a form of sort of little miniature sort of financing, if you like. And then aside from that, to improve the cash flow, it might be a matter of actually having to raise money, going to friends and family with cap in hand, to see if any of them want to sponsor or donate to your cause, put money in that way. And then if you're in the type of business whereby you're sending out a lot of invoices and basically what you're waiting on is, those invoices to be paid, then you can go for, I think you can get them through the banks, or there are also certain companies that provide invoicing finance. So what they will do is literally you raise your invoices, you send it to them, they release, say, 70% of the cash value of those invoices within say 28 hours, 24 or 48 hours, and then when the cash comes in, they're actually paid, you then can pay them back, and they take a small fee for that.
On that point, invoicing finance, I was going to ask you, do they charge interest on that? Or
all the companies are different. There are lots of different companies out there. Some might charge a minimum amount for a facility like that. Others might charge a minimum or a percentage of the total amount of cash that they release to you. You know, there's different sort of agreements that you can have, and the key thing though is that if that invoice isn't paid within, say, 60 days or 90 days, they're not going to assume that that slow paying debtor, or if that turns out to be a bad debt, they won't assume that responsibility. So you'll have to pay them the entire amount of that invoice, even though that customer hasn't paid you yet. So
right, so you have to be very careful with that.
Yeah. And also as well, sometimes they want to credit check all of your debtors before they will assume the responsibility of, you know, releasing 80% of that invoice to you as well.
I see. So far we've got credit terms.
Yeah.
You can obviously raise money by going to your mum. There's invoicing finance. Can raise money against invoices that are not yet paid. So you get the money in advance of when you would actually get it. Are there any other tips you have?
I think sometimes it also depends what you need this cash flow for. So if you're in a service-based business, some businesses only use, for example, subcontractors. And if you're using a lot of subcontractors, you might have an agreement with them whereby they get paid when you get paid. So cash flow becomes less of an issue. It's about, as soon as you get the money in, then you will pay them. And often in a service-based business, it's the wages, it's the subcontractors, it's the people, which is the biggest expense of the business. And then for other things, depending on what you need the cash flow for, some businesses might, instead of buying equipment outright, like computers or photocopying machinery or even vehicles, they might lease them. So you're making smaller payments that are going out instead of big chunks of cash to buy things outright. You're leasing it, but getting the full use and the full value out of that item that you're leasing. So that can just help ease your cash flow. So.
Okay.